Hello everyone, myself Videsh and my roll number is 536 and my topic is contribution margin budgeting. What is contribution margin? The contribution margin can be stated on a gross or per unit basis. It represents the incremental money generated for each product or unit sold after deducting a variable portion of the firm's cost. The contribution margin is computed at the selling price per unit minus the variable cost per unit, also known as dollar contribution per unit. The measure indicates how a particular part contributes to the overall profit of the company. It provides one way to show the profit potential of a particular product offered by a company and shows the portion of the sale that helps to cover the company's fixed costs. Any remaining revenue left after covering fixed costs is the profit generated. The formula for contribution margin is the contribution margin is computed as the difference between the sale price of a product and the variable cost associated with its production and sales process. Contribution margin equal to sales revenue minus variable costs. The above formula is also used as ratio to arrive at an answer in percentage terms as follows. Contribution margin ratio. Sales revenue minus variable cost by sales revenue. Sales revenue. Sales revenue is often referred to as to simply as revenue. It's all the money your business brought in, excluding only allowances and returns. It's usually the first thing you see on an income statement before all expenses are taken out to get the bottom line. Variable costs. Variable costs also live on the income statement, but they are not as easy as net sales to find. Instead, they are usually as line items within cost of goods sold, right alongside fixed costs. So finding your variable costs may involve adding up all the relevant line items from your income statement and then subtracting that amount from your net sales. Variable costs, generally speaking, are those expenses that fluctuate from month to month, usually in indirect relation to your sales. For example, if you run a dog grooming salon and have a strong month with more pups, and then normal stopping by, you will need to buy more shampoo to keep up with demand. The shampoo is variable cost in this scenario. Common example for variable cost includes raw materials, labor costs, shipping costs. What does the contribution margin tell you? The contribution margin is the foundation for break-even analysis used in the overall cost and sales price planning for products. The contribution margin helps to separate out the fixed costs and profit components coming from product sales and can be used to determine the selling price range of a product. The profit levels that can be expected from the sales and structure sales commission paid to sales team members, distributors, or commission agents. Fixed costs versus variable costs. One-time costs for items such as machinery are a typical example of a fixed cost that stays the same regardless of the number of units sold, although it becomes a smaller percentage of each unit's cost as the number of units sold increases. Other examples in Other examples include services and utilities that may come at a fixed cost and do not have an impact on the number of units produced or sold. For example, if the government offers unlimited electricity at a fixed monthly cost of $1,000, then manufacturing fixed monthly cost of ton, then manufacturing 10 units or 1,000 units will have same fixed cost towards electricity. Fixed costs are often considered as sunk costs that once spent cannot be recovered. These cost statements should not be considered while taking decisions about cost analysis or profitability measures. Contribution margin example. Say a machine for manufacturing ink pens comes at a cost of $10,000. Manufacturing one ink pen requires $0.2 worth of raw materials like plastic ink and nib, and under $0.1 goes to other electricity charges for running the machine to produce one ink pen, and $0.3 is the labor charge to manufacture one ink pen. These three components constitute the variable cost per unit. The total variable cost of manufacturing an ink pen comes to $0.2 plus $0.1 plus $0.3 equal to $0.6 per unit. If a total of 100 ink pens are manufactured, the total variable cost will come to $0.6 into 100 units is equal to $60, while manufacturing 10,000 ink pens will lead to a total variable cost of $0.6 into 10,000 units equal to $6,000. Such total variable cost increases in direct proportion to the number of units of the product getting manufactured. The profit per unit comes to sales cost minus total cost equal to $2 minus $1.6 equal to $0.4 per unit, where S is equal to sales price. However, contribution margin does not account for fixed cost component and considers only the variable cost components. The incremental profit earned for each unit sold as represented by contribution margin will be sales price minus TVC is equal to $2 minus $0.6 equal to $1.4 per unit, where TVC equal to total variable cost. In the above example, if the total number of ink pens manufactured and sold doubles to 20,000, the total cost fixed plus variable will be $10,000 by 20,000 plus zero point 0.6 equal to $1.1 per unit. The profit per unit will come to SC minus total cost equal to 2 minus 1.1 is equal to $0.9 per unit. Essentially, doubling the number of units sold from 10,000 to 2,000, 20,000 two times has increased the net profit per unit from zero point 0.4 to $0.9, that is 2.25 times. However, the contribution margin, which gets calculated with respect to only the variable cost, will be sales price minus TVC equal to 2 minus $0.6 equal to $1.4 per unit. The contribution margins remain the same even when the number of units produced and sold has doubled. It provides another dimension to assess how much profits can be realized by scaling up scales. Years of contribution margin. The contribution margin can help company management select from among several possible products that compete to use the same set of manufacturing resources. Say that a company has a pen manufacturing company that is capable of producing both ink pens and ballpoint pens, and management must make a choice to purchase only one of them. If the contribution margin for an ink pen is higher than that of a ball pen, the farmer will be given production preference owing to its higher profitability potential. Such decision making is common to companies that manufacture diversified portfolio of products, and management must allocate available resources in most efficient manner to products with the highest profit potential. Investors and analysis may also attempt to calculate the contribution margin figure for a company's blockbuster products. How to how the contribution margin works. The break-even point is one of the purposes for calculating your contribution margin. It exhibits the point at which a company covers fixed expenses and generates no profit. Break-even point equal to total fixed expenses divided by contribution margin ratio. You can calculate your break-even point in units to determine the amount you must sell to break even. This method uses total fixed expenses for your products and average contribution margin per unit. Calculate the average contribution margin per unit using the formula average contribution margin per unit equal to all sales plus all sales minus all variable expenses divided by number of units sold. Then calculate your break-even point in units. Break-even point in units equal to total fixed expenses divided by average contribution margin per unit. The break-even point can be used with other methods of analysis. For example, a cost analysis of fixed expenses could reveal a high amount of fixed costs. You could then investigate ways to reduce your fixed expenses. Analyzing a product's contribution margin break-even point provides information on the company's operational efficiency. These two measurements also give business owners information on pricing. Once you know the profit or loss a product is generating, you can begin to analyze and adjust prices accordingly. It's also a way to help structure sales commission or decide which products to keep in your product line and which ones to remove. You can apply your company's resources to those products with best contribution margins. And thank you.